One of the most powerful setups for married couples is when one spouse earns a high W-2 income and the other one qualifies as a real estate professional. And here's why. The IRS gives real estate professionals a special designation that can dramatically reduce or even eliminate their federal income taxes. This isn't a loophole, it's an actual status written into the tax code. To qualify, two things have to be true. First, you need to work at least 750 hours a year in one of the 11 approved real estate categories. Second, it has to be your primary job, meaning you spend more time in real estate than any other business. That's why most single W-2 earners don't qualify. But married couples, this is where it gets interesting. On its own, real estate professional status doesn't do much. It only works when you also own real estate property. When you own rentals, you report two numbers to the IRS, income and expenses. And in real estate, expenses can be much higher than your income. Those are called paper losses. For example, we own a $500,000 property that produced about $100,000 in losses over the first year. And here's where the magic happens. With real estate professional status, those losses can offset W-2 and 1099 income, not just your passive income. So instead of telling the IRS that you made $400,000, you report $300,000 and you're taxed on a lower number. That difference alone is about $24,000 in tax savings. Now think about that. You buy a $500,000 property, you put 10% down or $50,000, but that one property saves you $24,000 in taxes. In real terms, you didn't spend $50,000, you spent $26,000 and you're gonna make up that other $24,000 in rental income. This is how people in real estate legally pay less in taxes. And yes, it's completely legal. Follow me and comment rep and I'll send you the list of approved real estate categories.